Are you planning to buy a home, but your credit score is holding you back? Credit scores, those pesky three-digit numbers, are more than just figures. They're like a financial passport, reflecting your creditworthiness to lenders, landlords, and even employers. They matter significantly when you're buying a house, as they can influence the mortgage rate you receive, or even if you're approved for a loan at all. Imagine a credit score as a report card for your financial behavior. The higher the score, the more likely you are to be trusted with borrowed money. A low score, however, can create obstacles. It might mean higher interest rates, stricter loan terms, or being turned down outright. But here's the good news. Improving your credit score is not a mountainous endeavor. It's a journey, and it starts with understanding what goes into that score and how you can influence it. But don't worry, improving your credit score is not an impossible task. Stay tuned to learn how. Before we dive into boosting your credit score, it's crucial to understand your credit report. Imagine your credit report as a report card on your financial behavior. It's a detailed record of how you've managed your money, your debt, and how diligent you've been about paying your bills. In essence, it's a snapshot of your fiscal responsibility. Your credit report is comprised of several key components. First, there's identifying information. This includes your name, address, and social security number. Don't worry, only certain parts of this information are shown to protect your identity. Next, there's your credit history. This section outlines each of your credit accounts, the type of account, such as a mortgage, car loan, or credit card, the date those accounts were opened, your credit limit or loan amount, account balance, and payment history. Then there's the inquiries section. This includes information about lenders who have accessed your credit report within the past 2 years. It's normal to have inquiries. They happen when you apply for credit. Lastly, there's the public records and collections section. Any bankruptcies, foreclosures, suits, wage attachments, liens, and judgments are included here. It also includes information about overdue debt from collection agencies. To obtain your credit report, you can request a free copy from each of the 3 major credit bureaus, Experian, Equifax, and TransUnion, once every 12 months through the site annualcreditreport.com.now. Let's talk about the importance of accuracy. Errors on your credit report can negatively impact your credit score, and consequently, your ability to obtain credit. So, it's important to check your report regularly and dispute any incorrect information. This can be a long process, but it's a crucial step in ensuring your credit score is an accurate reflection of your creditworthiness. Once you have your report in hand and have ensured it's error-free, it's time to strategize on improving your score. With a solid understanding of your credit report, you're now equipped to move on to the next steps of boosting your credit score. Let's dive into those in our next segment. The first step to boosting your credit score is focusing on your payment history. Now, what does this mean exactly? Simply put, payment history is a record of your past financial responsibilities and how well you've handled them. It's like a report card of your financial behavior. Timely payments, my friends, are the backbone of a good payment history. You see, every on-time payment you make demonstrates to lenders that you're a responsible borrower. It's like saying, hey, I got this, I can handle my financial obligations. And believe me, this doesn't go unnoticed. But here's the thing. Late payments, even ones that are only a few days overdue, can significantly impact your credit score. This is because payment history makes up about 35% of your total credit score. It's the single largest factor influencing your score. So, every time you make a late payment, it's like taking a tiny hammer to your credit score, and trust me, those little hits add up. So how can we avoid late payments? The answer is pretty simple. First, set up automatic payments. This way, even if you forget about a bill, your bank won't. Second, keep a financial calendar. Mark the dates when your payments are due. This way, you'll always be prepared and won't be caught off guard. Lastly, if you're struggling to make ends meet, reach out to your lenders. Most of them are willing to work with you and may offer options like payment deferrals or lower interest rates. Remember, the goal here isn't just to avoid late payments. It's about building a strong payment history, one that tells lenders, I am reliable, I am trustworthy. So every time you make a payment on time, you're not just avoiding a late fee. You're building your financial reputation. You're improving your credit score. And believe me, a good credit score can open doors. It can help you secure that dream home you've always wanted. So, let's not underestimate the power of a good payment history. Let's embrace it, nurture it, and watch our credit scores soar. Remember, consistency in payments is key to a healthy credit score. Another vital factor that influences your credit score is your credit utilization ratio. So, What is this credit utilization ratio? Simply put, it's the percentage of your total available credit that you're currently using. For instance, if you have a total credit limit of $10,000 across all your credit cards, and you've used $5,000, your credit utilization ratio is 50%. Why does this matter? Credit utilization is a big deal because it accounts for almost a third of your credit score. Lenders use it to gauge how responsibly you handle your credit. A high ratio could indicate that you're over-reliant on credit, which could make you seem like a riskier bet to lenders. Now that we understand its importance, let's delve into how to maintain a low credit utilization ratio. The first tip is to pay your balances in full each month. This not only helps you avoid interest charges, but it also keeps your credit utilization low. Another tip is to increase your credit limit. Now, this doesn't mean you should start spending more. Rather, it gives you more credit to work with, which can lower your credit utilization ratio if you continue to spend the same amount. You could also consider spreading your charges across multiple credit cards to avoid maxing out one card. This strategy can help you keep a lower utilization rate on each card. But remember, the goal is not to increase your spending but to manage your existing spending more strategically. It's also crucial to keep tabs on your credit utilization ratio, not just when you're planning to apply for a loan or a credit card, but as a routine part of managing your financial health. Finally, avoid closing old credit card accounts. Even if you're not using them, these accounts contribute to your overall credit limit, and closing them could inadvertently increase your credit utilization ratio. Balancing your credit utilization ratio can significantly improve your credit score. So keep these tips in mind as you navigate your credit journey. Did you know that the length of your credit history can impact your credit score? That's right, folks. The age of your credit history is a significant factor that credit bureaus consider when calculating your credit score. It's like a time capsule of your financial behavior, showing lenders how consistent you've been over the years. Here's a fun fact. The length of your credit history accounts for about 15% of your total credit score. So, it's not just about how well you manage your credit now, but also how long you've been doing it. So how does this work? Well, the length of your credit history is determined by the average age of all your credit accounts combined. This includes both open and closed accounts. The older the average age, the better it is for your credit score. Now you might be wondering, what can I do to improve the length of my credit history? One effective strategy is to keep your old credit card accounts open, even if you're not using them anymore. Closing an old account can lower the average age of your credit history, which could potentially lower your credit score. But remember, this doesn't mean you should avoid opening new accounts altogether. New credit is also a factor in your credit score, and responsibly managing multiple types of credit can actually boost your score. The key is to maintain a balance. It's also important to understand that you can't artificially speed up the aging process of your credit history. Building a lengthy credit history takes time. But don't worry, every payment you make, every debt you pay off, and every day that passes are all contributing to the length of your credit history. In conclusion, the length of your credit history is like a financial resume that tells lenders how reliable you are. It's a testament to your long-term financial behavior. So remember to think long-term. It's not just about your financial habits today, but also about how you've managed your finances over time. So, think twice before you close that old credit card account. Adding a mix of credit types and new credit can also help boost your score. So, let's dive into the world of credit mix and new credit. A credit mix refers to the different types of credit you have. This could include credit cards, mortgage loans, auto loans, or even student loans. Lenders like to see that you're capable of managing different types of credit responsibly. It shows versatility and proves that you can juggle different financial responsibilities. And guess what? It makes up about 10% of your credit score. Not a huge chunk, but when it comes to credit scores, every little bit helps. Now, it's important to note that this doesn't mean you should rush out and get an auto loan just to diversify your credit mix. The key is to manage the credit you already have responsibly and naturally diversify your credit mix as your financial needs evolve. For instance, if you're planning to buy a car or a house, that's a good time to add an auto loan or mortgage to your credit mix. And how about new credit? Opening new credit accounts can also impact your score. But here's the catch, it's a bit of a double-edged sword. On one hand, new credit can help improve your credit utilization ratio. That's the balance of your debts compared to your available credit. On the other hand, every time you apply for new credit, It results in a hard inquiry on your credit report, which can temporarily ding your score. So how do you navigate this tricky landscape? Well, the best approach is to only apply for new credit when you genuinely need it. And when you do, ensure you can handle the payments comfortably. Keep your credit utilization low, make your payments on time, and your score will thank you for it. Just remember, applying for new credit should be done sparingly. So, in the grand scheme of things, a balanced credit mix and a thoughtful approach to new credit can be powerful tools in your journey to a higher credit score. Let's summarize what we've learned about boosting your credit score. We've taken a deep dive into the world of credit, and it's time to bring all the pieces together. Firstly, we explored the importance of understanding your credit report. It's more than just a number, it's a detailed history of your financial behavior. Going through your report with a fine-tooth comb can help you identify any errors or discrepancies that could be dragging your score down. If you spot any, don't hesitate to dispute them. Next, we delved into the significance of your payment history. Remember, consistency is key. Timely payments show lenders that you're reliable and can manage your financial responsibilities well. Late or missed payments, on the other hand, can negatively impact your score. So make a habit of paying your bills on time, every time. Then we took a closer look at the credit utilization ratio, how much of your available credit you're actually using. Keeping this ratio low is a good practice. Aim for 30% or less. It shows lenders that you're not overly reliant on credit and can manage your debt effectively. We also discussed the length of your credit history. The longer your credit history, the better it is for your score. It provides lenders with more information about your long-term financial behavior. So don't be too quick to close your oldest credit card, even if you're not using it frequently. Finally, we touched on the subject of credit mix and new credit. Having a variety of credit types, like credit cards, auto loans, or a mortgage, can positively influence your score. But remember, don't open too many new accounts at once, as it can make you appear risky to lenders. Implementing these strategies can help you boost your credit score, paving the way for your dream home purchase. It's a journey, not a sprint. So, take it one step at a time, and before you know it, you'll be on your way to financial freedom and the home of your dreams. Boosting your credit score might seem like a daunting task, but with these tips, it becomes manageable. The key is to start small. Like a journey of 1,000 miles begins with a single step. The journey to a better credit score starts with the first step you take. It could be as simple as paying your bills on time or keeping your credit card balances low. Every small action contributes to the bigger picture. And remember, Rome wasn't built in a day. Improving your credit score isn't a sprint, it's a marathon. It requires time and patience. It's about making consistent, responsible financial decisions over a prolonged period. You may not see immediate results, but don't let that discourage you. Keep at it, and over time you'll start to see your score improve. Think about it like planting a tree. You don't plant a seed today and expect a full-grown tree tomorrow. It takes time for the seed to sprout, grow, and finally become a tree. Similarly, your credit score won't shoot up overnight. It takes time for your good financial habits to reflect in your credit score. But don't let the time factor deter you. Every step you take towards improving your credit score is a step closer to your dream home. And isn't that a motivating thought? The dream of owning a home, your own space, a place where you can create memories with your loved ones. That dream is not as far off as you might think, so start today. Implement these strategies one by one. Keep track of your progress. Celebrate small victories. And remember, every effort you put in is bringing you one step closer to your dream home. Remember, your dream home is not out of reach. With a better credit score, it's closer than you think.